GM guys, we're back with another Touch Grass podcast. Super excited for this one. We are with Kaledora from Ostium. Rachit, I've been, talking about Ostium, bull posting Ostium for last, I don't know how many months. We are friends with Flo and Taha, and we've been in the groups chatting about all the programs, farming the airdrop and whatnot. So super excited for this one. Welcome to the show, Kaledora.
Thanks for having me on, guys. Excited to chat.
Awesome. I don't think I've heard you talk about your journey in the space and the story behind Ostium. I know that you have a bit of TradFi background. So why don't we start with what's the story behind Ostium? How do you guys started? And yeah, we can go from there.
Sure. I'll kick off with a little bit of just more like personal background and how Marco, my co-founder, and I met, and then I can talk more about the big picture vision and drill down more into the product. But yeah, I have a bit of an unusual background and sort of journey into the space. I met my co-founder Marco in college, freshman fall. We met the first week of college in intro econ class, an intro 600 person class at Harvard. I usually say we were the two most annoying or perhaps most opinionated kids in the class, constantly raising our hands and offering lots of unsolicited opinions on the markets, and perhaps generally more libertarian leading than most of the Harvard class. Eventually figured we should probably just talk to each other and start trading together rather than bothering everybody else in the class. So yeah, been very close friends and working together on stuff, trading together and building a company for more than 6 years now at this point. We met in 2019. Before that, I started college in my early 20s. I actually had a first career as a professional athlete. I was a professional ballerina. Ballet was sort of my first love and obsession. I usually hyper focus on something for like 10 to 15 years so far. So I started ballet when I was very young. I trained at School of American Ballet in New York, and then danced professionally for 5 years in Boston, and then at the Royal Danish Ballet in Denmark. Retired, went back to college, thought I wouldn't make any friends because I was sort of a little bit older than the rest of the freshman class. But as it happened, met Marco, we became very close and started, trading together. While we were in college, we both worked at a couple different hedge funds. I spent one summer working for a small cap value equity fund, looking at a lot of value stocks, was sort of trained in those ways. And then I spent a summer at Bridgewater as well, working directly with one of the CIOs there. Kind of a unique position. Marco was there for a summer too on the commodities team. And somewhere along the way, we fell on the crypto rabbit hole. I think slowly and then all at once, everybody has sort of a very different story. I mean, I've talked to, I'm sure you guys have seen this too, talking to a lot of founders, like everybody has like a very different story, and yet the story is like kind of the same. It's like, there's no like really, unless you're like studying academic cryptography, there's no like really academic way of getting into the space. You kind of just like start doing stuff on the internet and like, just be other people's exit liquidity for a while before you're really motivated to figure out what's actually going on under the hood. So we started playing. I would say we came at it from like a very sort of like first principles perspective. I mean, obviously we were playing around. I mean, I was like exit liquidity other people in Anchor. Obviously didn't take my money out in time. Playing around in DeFi, reading a bunch of white papers. The first things that we really, I would say, became obsessed with were like synthetics and mirror, and this whole concept. And we haven't really strayed from the core obsession with one single idea, which is how do you create the best trading experience for TradFi assets using a blockchain as settlement. And there were, I mean, we have to credit sort of this is not an entirely novel idea. There are people who have been thinking about this in some form and experimenting. There have been different versions that we learned a lot from. The early versions really pioneered sort of like a CDP, like collective debt pool minting, like on synthetics. They had SNX token. You would mint like a synthetic JPY or synthetic gold or whatever. So we spent a lot of time playing around with those protocols and trying to understand how they work and what worked and what didn't, and developed, I would say, this sort of like first principle zoom out book, and you look at the section entitled Our Thesis. I wrote that like 3 years ago, and I think it's more true now than ever. It's wound up being quite correct, which is basically the view that like macro news is the new reality TV, and neither in crypto nor in TradFi have the trading platforms caught up with this. There's no product that's fully caught up with the fact that the new sort of quintessential trader in a post-COVID world is someone who wants to trade across asset classes because they're tracking macro. And I think, I mean, there's some very clear examples of this, right? Like, you used to be able to just trade. The initial evolution of retail trading with Robinhood and eToro and many of these products happened at a time when, most retail was trading stocks. People are DCFing stocks. That was sort of like, if you're in a zero interest rate world with not too much macro volatility, certainly compared to now, like growth stocks and tech stocks, the FANG stocks, Mag 7, whatever you want to call it, dramatically outperformed. And you saw most of the attention sort of directed towards making stocks specifically easier to trade, like the rise of options, fractionalized stocks, no fee trading, those sorts of things. Or separately within crypto, right? Like all the infrastructure that was built for trading crypto as an asset class specifically. So people really stayed siloed within their asset class. And that made sense in a world where the primary drivers of like price were the internal dynamics of a specific company. So you might be DCFing a stock, or the 4-year Bitcoin halving cycles and what that means for the general crypto market. But we're in a very different world now. And my view is that like crypto broke something in the market, or sorry, COVID broke something in the markets. And in a post-COVID world, macro is the primary driver of price action. And I mean, there's some very clear examples here, right? Like if you had been just trying to trade, if you weren't paying attention to macro and you didn't you weren't paying attention to the yen carry trade unwind when it looked like the BOJ was going to raise rates, or tariffs, or, and the implications for, right? Like if you weren't tracking that stuff, you got totally wrecked. Like you could not, even if you just want to trade crypto, you cannot just trade crypto and not pay attention to tariffs. You just can't. And like, or, the ETFs or whatever it is, all the big drivers of this cycle within crypto and outside crypto have been macro. And so tying all the pieces together, the core insight was nowhere in crypto nor outside of crypto has the tech or have any of the products and trading platforms out there caught up with this fact that the new trader of today wants to trade cross asset easily, and they don't want to learn a new instrument every time they want to trade a new asset class. Like right now, the status quo is like, you want to trade commodities, you got to learn futures. You want to trade stocks with leverage, you got to learn options. You got to learn a new, there's all sorts of things you have to account. Trading options is not easy. You have to understand implied volatility. It's not just like, call price goes up, I made money, put price goes, like more complicated than that. So learning a new instrument, we're going to a new platform every time you want to trade a new asset class is not going to be the way of the future. And similarly within crypto, having to go and off-ramp your money to send it to, interactive brokers if you want to trade gold because gold is ripping. And the time you waste on that, your time is money. You have to pay fees to off-ramp. Off-ramping capitals keep it treated differently in different countries. A lot of people, if they made money in crypto, they want to keep it on chain. To off-ramp, you have to send it. That's going to take time. You have to pay fees. You then have to go send it to your interactive broker's account. You're wasting days on this. And then you also, by the way, have to trust the broker, right? If you grew up in crypto, you ideally want to self-custody your funds. You now have to go and trust a broker, and you probably have had bad experience with centralized exchanges or centralized brokers. So the big overarching vision is one platform, one instrument, all assets from a wallet. So anyone from anywhere in the world can connect a wallet, easily on-ramp stablecoins through a very simple process and trade any asset from Tesla to gold to oil to the Japanese yen to the 10-year to BTC, whatever it may be, with a single instrument, long or short, with leverage or not, and from one platform. And so we've sort of been building towards that vision since day one. The protocol has taken a few different iterations. We've done a lot along the way. There's a lot more to learn, but that's the big picture vision for Ostium and how we got there.
Also, like before Rashid, you go, you said the macro is playing a big role. I think the bad part of that is like right now everyone is a macro enthusiast and macro expert, and everyone tries to understand what's happening when everyone's a macro expert when no one knows what's happening. Yeah, go ahead, Rashid.
I actually wanted to ask more about like the ballerina arc. Like, do you guys still catch up, like you friends? Like, what do they think of Kaledora, the Perpdex founder, versus Kaledora, the ballerina?
It's a funny question. It's just a completely different world. It's very hard to explain to I'm still very close with a lot of my friends from the ballet world and friends in Denmark. And I always go back to Denmark once a year. And it's a very it's a very like grounding experience for me. It just like I had such a different life. It's very hard to explain. Like I mean, I could talk about this for hours, so you'll have to interrupt me. But yeah, I mean, most of my like ballet's quite funny because it's like it is a very kind of like posh thing in some ways, but it's also very not posh. Like it's really hard fucking work. Probably, I don't know if I should swear on this podcast, but anyways, very hard work. It is like, it's blood, sweat, and tears. Your feet are bleeding. Like it's it's manual labor, for lack of a better word, right? Like I was in a union. Like ballet dancers are in unions, and you can get paid barely nothing. I mean, truly, really, really not a lot. And it's most people that I worked with like didn't finish high school. They're all very smart. They're very different kind of, sort of like aesthetic and artistic and like, athletic intuition is very different from like, doing funding rate math.
Yeah.
And so the people that I danced with were very brilliant in this completely different way that I think most of the people that I work with that are just like in our world today, perhaps are less familiar with. And so, yeah, I think my life, most of the stuff in my life, in my world today, it's hard to even describe what my life used to be like. Like my job every night was to like get up on stage and like put on a costume and like sweat and dance in front of an audience of thousands of people. It's hard to even convey what that experience is like. And it's just like, has literally like almost nothing to do with like my job now. And conversely, the same is true. Like, yeah, most of my like dancer friends, I mean, they don't know what a perp is or a dex is or what crypto is or whatever. So I just, in their head, I'm like a tech
Yeah.
now. That's
You know
how I
what's
describe
really funny, Kaledora? Like you literally just described the average crypto enthusiast, like someone who probably hasn't finished high school, probably doesn't get paid much. They're part of a DAO. They're smart in a different way. There are probably a lot more similarities than
Yeah.
obvious. Okay.
I also think I'll say one thing on that, which is like I also think there's a lot of like lessons that I learned from ballet that have served me like enormously as a founder, but that didn't become apparent to me until I was like just further along the journey. Like in the beginning, I'm like, holy shit, this is so different. This has like, and then like over time, I'm like, oh, this is like when I like pushing through this like really tough moment or figuring out this like really tough question actually is, I'm like leveraging the same sort of mindset as I did when, the two lead dancers who were doing this role that I had like, 5 rehearsals for and never had a stage rehearsal for, got injured on the same day. And I had 3 days to prepare for doing a principal role. And I caught the flu and I was dancing with 104-degree fever. It was like, there are just insane experiences that you go through as like a live performance artist, like ability to sustain just hits, like shit going wrong, and the ability to like just operate and improvise within completely changing circumstances. Like you could be on stage and someone falls or someone gets injured. You just got to keep improvising, keep looking, keep paddling like duck, keep paddling under the water, and like you look really calm up top, and no one would guess that something went super wrong. That is, I think a lot of that is like very similar to what you just have to do as a founder. Like as a leader, you have to be strong. You have to like keep doing your thing. Things will go wrong all the time. Just have to look at everything as a solvable problem, and you like keep pushing and iterating no matter what happens. And I think, yeah, that part's very similar. I think it's the same for anyone who, it's just like learning how to do hard things. That's like the high level
for sure.
headline.
One part of the podcast that me and KG always try to deep dive into, like what is the founder's past or whoever the guest is, like what sort of motivates them and what sort of shapes their like current experience. So I think this has been really helpful for our audience, and this is probably a side of you that they probably don't even know about, that we've sort of talked about right now. Kaledora, I do want to go back to our last question. You talked about the thesis of Ostium, and I want to bring this back into the crypto world. You talked about Ostium's thesis and how it's a place for anyone with any level of experience to trade. Can you talk a little bit about where Arbitrum fits into this thesis and when you were convinced that Arbitrum is the chain that you wanted to build on? Talk about how the Arbitrum DAO or the Off-Chain Labs team, how they've supported you over the time you've been building.
Sure. look, Arbitrum's an incredible place to build. We wanted to build on the closest thing to ETH. We couldn't build on ETH mainnet just because of, I mean, we're building like a high-speed app where low fees are important and all that stuff. So we wanted to build on the L2 that was the closest thing to Ethereum. And I don't actually think this is a controversial statement at all. Like Arbitrum is that. It is, and this is also I haven't talked about this yet, but like I alluded to it somewhat in terms of like, if you have to off ramp your money, you also have to like trust the broker and you have to trust the place that you're putting your money in. Very central to our value proposition as we expand like beyond the initial crypto beachhead market that we've targeted is this sense of like this sort of trustlessness and like credible neutrality, that you don't need to deposit your money into some centralized custodian. Like you are self-custodying your funds. If you open a position, it's on a position by position basis. You put the collateral into a contract that is open source, that in theory you can look at the code, and where everything's recorded on a blockchain. I know this is like pretty elemental stuff for like a crypto audience, but that's not like that is like a very, very important value prop. And I think it's like easy to take that for granted within crypto, but like outside of crypto. Yeah. And we wanted that like to stay the most true to that sort of vision and like that being the case. And yeah, Arbitrum is like, I think just the clearest, like closest thing to Ethereum where you get the like speed and benefits of an L2. And then on top of that, the Arbitrum team has been very supportive. You know, I think Arbitrum's done an incredible job in the last several months, especially of just really just focusing their attention on like builders and highlighting apps. Like I think it can be sometimes, I mean, we've been building for a while and like there was a time, only recently have the winds shifted towards like valuing app builders and like real products and real revenue. I always find this funny. It's like the revenue meta. It's like, no, that's capitalism. It's called, you know, business and having generally
100%
and like sustain yourself. So yeah, but like the space is maturing, right? And people are, I think, I always say that like the fat protocol thesis and its consequences have been a disaster for the crypto ecosystem. I think sanity is perhaps returning or beginning to take hold for perhaps one of the first time. And I mean, I've believed this since the beginning that I don't think crypto is like somehow an anomaly here magically because it's Web3 or whatever. Like, no, the value will accrue. We're like inherently visual creatures as humans, and the value will accrue to the application layer that sort of has those relationships with users or is aggregating sort of like intent, for lack of a better word. And I think it can be it was certainly one, this was more common. It just is less common now, but it was disheartening when you're trying to like really focused on product to just see that somehow the like primary approach for most apps was like doing chain hopping and grant collection, which I suppose was like a very efficient way of collecting non-dilutive capital. So I, you know, salute those who did it, but that's not really what I found particularly motivating. Like I find it motivating to build a really good product that I think solves like a really important problem. And so, yeah, we considered going other chains, blah, blah, blah. But it's just like, we really just wanted to be on the chain that we felt like satisfied the very important technical and credible neutrality requirements as Arbitrum does, and just triple down on product. And I am so happy to say that like the Arbitrum team has been very supportive of that. And they really like are there for app builders. And like, so yeah. It's great.
That's amazing to hear. We just had the Arbitrum, some of the delegates over the last couple of days as well. And they have done a lot of grant programs and their approach has been quite different. So it's always some unique protocols coming out of that chain. But yeah, I want to, go back to the perpification, the one you coined over the last 6 or so months ago. Talk to me, like, why is Perps like the best product out there? Like, everything, people say it's like the most easy to understand product, as you said. Why does everything become a perp eventually, in your opinion? And then we can also talk about some of the prediction market stuff as well.
Sure. And I coined the term like 1.5 years ago, but I don't know. I had some tweet that was like, you need to be wordsmith maxing. You need to be like a modern day Shakespeare. I really believe this. I think if you want to like, mind control is like coming up with words and like inserting them into the common jargon. So
yeah,
perpification. Yeah, and I just thought of that as like an alternative. It was so the whole like RWA discussion was all focused on like tokenization, which is just like have this off-chain holding company, put the asset in there, have a minting redemption process, then have like a tokenized representation of the underlying thing. And it just struck me as like, yeah, I mean, that's a great business if you're an issuer. Like, look at how much money, especially if you can charge a massive spread, or you can just like not pass on the interest rate that you're earning on the thing you're sitting on, i.e. Tether and Circle. These are obviously great businesses, but they totally serve the needs and demands of on-chain users if it's a stable coin. So if the thing that you're tokenizing, a dollar treasury, is a means of exchange or a store of value, but not if it's a trading instrument, not if it's something primarily that people like. So we're not using Tesla. It's not like, let me send you 3 Tesla for like dinner. It's like, people are not looking at, besides like a dollar or like gold as a store of value, largely the other assets out there, and some money market funds or some whatever you want to, like treasuries, etc., different types of like tokenized debt instruments that might be yielding some rate. But beyond that, like the whole other sort of universe of assets, at least for where the space is right now, in the level of, I think, just sort of the demand profile of existing on-chain users, people want to trade this stuff. They want to bet on it. They want to express a market view about what they think is going to happen in the future. They want to take a position on macro, on like global events, whatever it is. And in that case, like a tokenized version of the thing is really not. There's the first principles part, which is like, okay, well, you can only go long functionally, right? Because you have to buy the thing, and or like easily go long, let's say. And obviously it's not capital efficient. You have to just buy it spot. But then there's the second part on top. So that's just like baseline. So if you could easily long or short in one click, it's just like long, short, and you can add leverage on top and be more capital efficient. That's obviously like a Pareto improvement.
Addictive as well.
And then on top of that, there's also the dimension of liquidity, like, which it's not even, it's like, that's a whole other thing on top, which is what kind of execution can you get? Like, how much size can you move without moving the market? And if you are listing all these tokenized assets, and by the way, I think people are also just ignoring the fact that, like, if you thought that the USDC native, USDC.E, wormhole bridge USDC, layer 0 bridge, it's like, if you thought that was a fiasco with having like 10 different versions of a stable coin that all had split liquidity, just wait until you see tokenized stocks, because everybody's going to want to become, there's more companies, there's more infrastructure companies in the space now, there's more infrastructure to tokenize things. Everybody's going to want to be a tokenizer. And so you're going to have, A tokenized Tesla, B tokenized Tesla, C tokenized Tesla. They're all going to have different liquidity profiles. And you're going to just wind up, I mean, even right now with a lot of these tokenized products, and I won't name names, but like the max size that you can move, like the biggest sort of in a single clip, position that you can open, or let's say amount of the tokenized stock that you can buy, is not more than like 500K. And at that size, you're moving the market like 7-8%, like 7-8%, right? Like 800 basis points. And if you want to move, let's say 250K, you're moving the market, 2-3, kind of, depends on the day. Last time I checked, it was like 3.5%. So that is insane levels of price impact. And so generally not a great experience is the summary. I'm not saying that tokenized assets, tokenized stocks for now are not going to be, very big, but I think that becomes true when the demand profile of what people want to do on change dramatically changes and becomes far less speculative than it is right now. And right now it's very speculative. And also just when you start to see like actual native issuance. I think all these tokenized wrappers are functionally like worse perps, because most of them don't even grant you governance rights, and they don't grant you dividend rights. So it's still synthetic. You can't actually do the governance. Like, you're not actually entitled to any of the rights that you would be entitled to if you were a stockholder, and you just can't short it, and like you can't take on leverage. So it's just like a worse perp. I'm not saying that that's
on that.
Yeah,
on that, like, I wanted to ask your thoughts on one thing, because what here is in, like, if I can summarize, is people would rather long or short something than hold an asset in these days. That's why speculation rise. But like, what do you think about that future where people would much rather trade with so much leverage than holding assets? That kind of behavior in market participants, how do you see that kind of emerging over the next couple of years? And it just feels like people would rather hold some meme coins than some good stocks, and they would rather trade with insane leverage on chain these days. How do you see that like kind of behavior over the next? Do you think that just keeps accelerating and that kind of speculation, or we kind of see more of buy and hold become the norm again? Like, yeah,
I think that's
So
also become a practice because like perp listings have become a lot more faster this cycle than last cycle, which is why like you're able to take positions of size a lot more easier, and it's become an opportunity now. But yeah, Caldor will, would love to get your take on this.
super high level, TradFi is going to become more like crypto, and crypto is going to become more like TradFi. There will be a convergence. So, we are in a sort of hyper gamification, like hyper speculative period. And I don't see that, decelerating anytime soon. I actually think it's likely to continue accelerating, but I mean, it can't accelerate ad infinitum, obviously, like there's a limit. But I think generally, I mean, look, with all these like DATs, DAT, whatever you want to call them, TradFi is becoming more like crypto and more, even look at the traditional, I mean, the CME announced they're doing prediction markets, right? So like the TradFi is becoming more like crypto, and crypto will become more like TradFi. So the answer is like, we are for sure, I think the evidence is abundantly clear at this point, entering this like hyper financialization era. So that is a general trend I would be very long, but will people who are on chain, in 5 years have, will spot relative to perp activity, like will the average leverage of a position in 5 years be the same as it is now, or be like 10x what it is now? I don't know. But I think as like a general trend, hopefully that answers your question. Yeah. So certainly people will want to do buy and hold. I think part of it is just this like mental compartmentalization for people, like of their behavior. So, and this is true for me, and this is true for a lot of people that I know. I do a lot of my really boring stuff off chain. So, put money in a CD, or, just sit on the S&P or whatever it is, or a set of stocks off chain. And then I do all of my risky and sort of crazy and high leverage activity on chain. And I think that's true for a lot of people. So it's not necessarily that if you, you're looking at like, there's a selection bias as well. So I think the trend is generally correct. Plus, there's some level of selection bias where people tend to compartmentalize their more risk-taking activity on chain.
Yeah.
So I actually think, okay, I'm making like a sort of abstract prediction here, but like I think you could actually see a world where like the average leverage, if you look across or spot like perps, goes down in 5 years, but the relative amount of people's portfolio that is leveraged in high risk goes up. But the reason the relative leverage, like the average leverage, goes down on chain is because people just move more and more of their portfolio. Even if the split goes from like 80% conservative, 20% degen to like 50-50, the fact that they're like maybe moving some of their conservative activity on chain, that starts to become just like a hub generally for their finances, rather than just like purely speculative activity, might drag down the average. So I'm making wild speculation right here, like based on zero data, but I could imagine that might be true.
Yeah, I think KG, this also goes back to, you remember when we had Vishal on the pod and he was talking about how he would never own an asset that he could not have an option against? I think for the average retail trader, there is no education around how to hedge opportunities, and as like crypto emerges as this place to hedge opportunities, then what Kaledora is talking about, they hedging is I would consider hedging as like a more conservative investment vehicle, and that's the type of investment they would do on chain for their off chain investments, for instance. Maybe that's sort of how this will evolve into it. The more efficient markets get, the more
a hedge again. Do you mean a hedge in the sense? Do you mean like a literal hedge, or do you mean more of like a figurative hedge in the sense that like some boomer person with like 2% of their portfolio in Bitcoin sees Bitcoin as a hedge against like government collapse and hyperinflation?
No. I mean like an actual hedge, like an actual hedge. Yeah.
So you're saying like delta neutral sort of like type strategy funding radar.
Yes.
Yeah. Okay.
Yeah.
Yeah, I think.
Yeah, I think.
Go ahead.
Yeah, I was just saying, like, I think the speculative nature will just continue and take different forms. Like, for example, like over the last just 12 months, the way Perps as product has taken shape has changed a lot, in my opinion. And right now, we see a lot of interface changes as well, where even you don't even need to have these sliders leverage. People can just tap these kind of products that are also coming out. So I think just the way people interact with these Perp products is just going to accelerate as well. That's why I'm super that's why people have these doomerish vibes as well, where we're entering into this hyper gambling kind of era, and everyone's just gonna trade their way up, kind of thing. But anyway, that was super insightful, Kaledora. But I wanted I wanted to get your thoughts on, everyone is right now like bullish again on prediction markets. You mentioned bringing stocks on chain because you can't move much size, the liquidity is not there, and the slippage is too much. Uh, in a similar sense, for some of these prediction markets, there's not enough liquidity. How do you think like a cross section between perps and prediction markets? I've seen some new project raise a new from the Kalshi and Polymarket team as well, like bringing seamless kind of order book kind of style or something. What are your thoughts on prediction markets, and how do you think like perps can play a role in kind of making them more seamless?
I've bbeen very bullish prediction markets for a long time. It very much plays into our high level thesis of sort of macro news is the new reality TV. I don't think there's a pretty good encapsulation of that. If your question is specifically about the intersection of the two, and I suppose the insinuation is like, do I think that a perp on a prediction market price, like the price of yes or price of no on some event, will exist? Yes, but I don't. Look, I wrote about this actually like over a year ago. I have an article I should post on my. Yeah, I guess I haven't posted it on Twitter, but I posted it. I linked to it. April 2024, and it was perps as like perpetual prediction markets. And I specifically dug into. You guys can share it in the show notes or something. But I dug into what happened during the gold price, like Pax Gold dislocation over the weekend. I think it was the weekend of like April 13th or something, 2024. It was when there was a huge fear around things happening in the Middle East. And it looked like things might, I believe it was the weekend when people thought that like they might like bomb like Iranian oil fields or something. And so gold, went through the roof, even higher now, but it sort of pumped going into the weekend. Or actually it pumped. So the gold market closes like 5 p.m. Friday, reopens 5 p.m. on Sunday. And on Saturday was the day that it looked like there was like the speculation that Iranian oil fields might be bombed and a bunch of people wanted to buy gold. And so obviously you could buy it OTC, but in terms of like the normal market, it was not open, but Pax Gold obviously exists on chain. And so there was a momentary spike. Someone must have thrown in a massive order and didn't, TWAP in. But the Pax Gold price pumped at one point to I think 21% premium on the closing price of gold on Friday. It then receded. There was a sort of massive spike, and then it sort of receded. And then interestingly, it basically renormalized to, it came within like 2% basically of where the gold price on Sunday evening at 5 p.m. like reopened. And so, or sorry, 6 p.m. I'm like telling you the wrong time, 6 p.m. So it came within like very, very close to, so it effectively acted as like a predictor is what I'm saying. So like it absorbed the excess like demand for gold that like of people who maybe didn't have access to an OTC market and wanted to buy it on chain. And then you saw it basically converge to within a very close, if you would like looked at the Pax Gold price, like, 12 hours before the underlying gold market reopened, it was effectively like a predictor of where the gold market was going to reopen. And the gold market gapped up, obviously, like when it reopened. And so I looked into the data, and sort of the thesis was like, these like some illiquid 24/7, still illiquid 24/7 markets will become like an interesting predictor. They're basically perpetual. They're like perpetual sort of prediction markets while the underlying market is closed and like where the market's going to open at. And so I think they're very interesting as a source of information. and this was, I was looking at Pax Gold, to be clear. So I was looking at gold spot, but I was drawing the analogy to the way in which like a perpetual could on this asset over the weekend could become a predictor in a very similar way. And you might even see just like more extreme moves because people are trading stuff with liquidation, with leverage. You might have like cascading liquidations. And so good indicator basically for sentiment on the underlying market. And so I think it's very interesting as an information source. Do I think it's necessarily a good trading experience? And will it be in the near future? No. And like that is why we have opted for our architecture. We don't have an order book architecture for very, very important reasons, because we have a single mission, which is to offer the best experience trading and the best pricing for any of these TradFi assets that is genuinely competitive with the underlying market. And we're not trying, like that is the function we're optimizing over. And so we're going to quote you the prices from the most liquid market. And rather than trying to recreate our own native order book liquidity on a, Tesla perp, we're just going to quote you the underlying Tesla price. So as a result, right now, we are bound by the sort of time constraints of the underlying market. We can't quote you a Tesla price if there's no Tesla market or liquid Tesla market that's open. That will change. But right now, that's where we're at because of what we've optimized for. So the answer is very into the concept of like sort of prediction markets as a general trend. I think they're only going to get bigger. I felt very strongly about this for a long time. And I think there will be an interesting intersection of like perps and prediction markets. I'm sure plenty of people are building perps on prediction markets. We looked at it very seriously. And we didn't do it because we couldn't guarantee what I was describing, which is our objective function, which is to offer the best trading experience in a way that is actually like manipulable, where we can be like incredibly neutral. Like if you could just manipulate the price on one of these things, you can just move it massively. That's not a good trading experience. And so we didn't want to offer that. I will say one last thing at this point. We've now since deprecated the product because we focused on we will be rebuilding it and integrating more of a social function around it. I haven't talked about it in a while, but we launched a sort of side product on top of the core Ostium Perps product called Strategies. You can still find the page actually. It's like on our app. If you go under trade, you'll go down to the bottom and you can find Strategies. It's we don't allow you to open a strategy now, but we launched it around the election because, as I'm sure you guys recall, going into the election, everyone was like, I want to trade the Trump or the Kamala win odds on leverage. They wanted to bet on that. They wanted new ways to bet on that. And we thought about it a lot, right? Like we looked at the price feeds. We were like considered listing the stuff. We found it. We were like, oh my God, you can't offer this stuff with leverage. If you offer it with leverage, it's super easy to manipulate. Like how also do you offer a perp on actually what is an expiring market, which is like when the election happens, the market expires. It's like the little bit of an oxymoronic thing. And so what I realized instead was, hold on, everything that I'm seeing on Twitter, the way everyone is talking to me about their views on the election is not like, I want to bet that Trump's going to win. It's like, if Trump wins, I'm long BTC. Like if Kamala wins, I'm short ETH. It was always like an if-then statement. It's like, if the BOJ tries to hike rates, I'm shorting the market. Like I'm shorting the S&P or the Nikkei, or if Trump's tariffs actually take effect, I'm shorting the market, whatever it is. So it was always an if-then statement. That's how people think about trading macro news. And so my thesis was, it's actually more interesting to use prediction markets as a source of information than it is to trade them themselves, because the slippage and the cost that you face, the liquidity on those markets is just not super great right now. And so you can trade the underlying market, but you're going to face a lot of execution costs. If you're trying to add a perp on top of that, then you're subject to the fact that this market could be, it's not that hard to manipulate. It doesn't take that much capital. So you can't offer a lot of leverage and you can't offer a lot of open interest. And so the more interesting way of leveraging a prediction market in a perp context is using it as an information source rather than a spot instrument to create a derivative on top of. And so Strategies allows you to do the V1 of Strategies, very, very simple. And the way it'll be built out is there'll be a whole social function. This is going to come in sort of this is a next big product push that we're going to be going after. And if anyone listening has any thoughts or specific requests or ways that they want to trade the prediction market events, DM me on Twitter. But was simple if then. So if the Trump win odds are higher than 70%, long BTC. And what was really cool is I got a lot of messages the morning of the election from people in all sorts of different time zones saying I couldn't stay up until 6 a.m. watching the US election until it got to like a really high percentage like win rate for Trump. But I basically, and some people even fully like, they basically hedge themselves. So they went like, if the Trump win odds are higher than 70%, that's like their point of no return, or 75, whatever your number is. Like, all right, if the win odds on poly market are like 80%, like pretty confident Trump's going to win. Like if the Trump win odds are higher than 80%, long BTC. And if the Kamala win odds are higher than 60%, then short ETH. And then you go in and one of your trades doesn't get executed. So there's no loss. It's not like, going long Trump and Kamala at the same time and being quote unquote hedged on poly market. No, like only one of your trades gets executed. So you have to be correct about like the effect of the outcome on the market. But it allowed you to effectively front run the market rather than like waking up and waiting to see, okay, he's won and now I'm longing BTC. A bunch of people opened like if Trump win odds are higher than 60%, 70% long BTC, and they woke up with a nice green. So
I remember like I remember like seeing this live on CT where I think Polymarket got the Trump win way earlier than the TradFi news outlets because it was already around 90%. And when immediately once that was out, Bitcoin I think shot up crazy percentage gain, right? And this was before even there is news that he actually won. So that's actually alpha right there. And I think our next question is, what's your like listing strategy right now? Is it like, let's just list more stocks, or we want to list more altcoins, or what's your like kind of a demand right now that, what's your focus? Is it more TradFi adjacent or crypto coins more?
The next thing that you should expect is more crypto stocks and DATs. So that's where we're seeing the most demand. I've run a few polls, talked to a lot of traders. People want like MSTR and those sorts of things. That's the next thing on the docket. Right now we're working on basically shoring up our, we've been a little bit slower than we wanted to be on listing those. We basically need to like shore up a little bit more of our Oracle infra. A lot of the constraints are usually around data. Oracle price is the reference price, so we have to be very, very confident that the price is correct and safe. And we have multiple data providers. We never list anything without a minimum of multiple data providers. And so sometimes one will be really good and won't be as good, or two will be really good and two won't be so great. So it's more about getting, and it really depends on the asset as well. Like some data providers that are great for the Mag 7, which we have listed, will be really crap for some sort of more long tail assets with a little bit less liquidity. The drop in quality is like sometimes not linear. It's like they're really good for the top and they're just crap for everything else. So we are working on shoring up that infrastructure on the data and just on the general sort of deployment side to be able to list things super, super quickly. One thing I really admire Hyperliquid for was just the way they utilized sort of a product and listing strategy as effectively marketing. And I've said this for a lot. This is also in an article that was, there was Shoal Research did an article on sort of like us from a while ago. You can look it up, and there was a section in there I think where I asked them to reference the listing strategy of Hyperliquid and sort of our thesis around approaching it, being inspired by that, obviously for a different use case. So it's not so, Hyperliquid was like, whenever something was all over someone's timeline, they're the first ones to list it. And they, came up with the Perps, but even before the asset was live, you could trade it there. I mean, look at the volume they did on Pump Fund before Pump, on Pump token before it even launched. So incredible strategy. For us, it's different because it's not like, soybeans are appearing for the first time as a future. It's just like if the soybean price goes crazy and suddenly everyone's talking about it. You guys perhaps recall, I think it was a year ago or so, where the frozen cuts orange juice, the FCOJ price was mooning and cocoa was well. So when that happens, it's not like that's the first time the asset appears. We're the only place to trade it, but we're the first one to list it in the capacity that we have it. And so we've internalized like a majority of this sort of Oracle infra and the data relationships in order to be able to do this in a very agile way. So we have the infrastructure to be very agile. The next focus is, as I said, sort of crypto and treasury stocks. We know there's a lot of demand for that. We will be listing those. We are just sort of in the final stages of like, it's just that each new asset class, as I said, like there are some nuances sometimes where you have like roadblocks at the data level that we're nearly talking through. So those are coming around.
Yeah, 100%. I think it's like they're more crypto kind of native, and it's like they are more focused on the newer projects that are going live. And uh, I mean, the pre markets are kind of interesting right now. Like what happened with Plasma over the last couple of days is quite insane. What happened, but awesome. I think we're coming up on time. Kaledora, we always ask our guests this final question. Kind of we flip it out, and hopefully it inspires other builders as well. What's your number one advice for app builders specifically? Because you've seen it all over the last couple of years. What's your number one advice for app builders in the space in general? Any advice on the product side, or even anything that you want to share with the community?
Sure. It's always a hard one because I have a lot of thoughts. My most important piece of advice, I think, would be think big. I do believe this is changing, but there has been a little bit of a history in crypto specifically. I think of people referring to what they're building. My advice would be if you're starting something, like it's not a project, it's a company. You're building a company. You're building a real company. Like think big. Do not like artificially constrain yourself. And I think sometimes, I mean, I've fallen into this trap myself, is like you, not to get too philosophical, but you sometimes can like artificially constrain your vision or the scale of your ambition out of a fear of failure. So, well, you haven't really failed if, you didn't really, like you didn't fail at building a $10 billion company if you never really tried. And that's a very toxic, just in general in life, I think for anything you do, company or anything, to think artificially constrain your ambitions or your dreams, like out of a sort of reactive or like preemptive sort of like clenching like fear of failure. And I don't know whether most people who are saying they're building a project are doing it for that reason. I would suspect that that's part of it. And so, yeah, my advice would be like, take yourself seriously. You're building a real company, think big company, say it to yourself, like look in the mirror, tell it to your team, tell it to your co-founder, that is your goal, and like take yourself seriously. And I really think this works with other people and it just works with yourself. People usually rise up to or conform to your expectations of them. If you have very low expectations of them, they usually satisfy those low expectations. If you have very high expectations of them, they rise to meet the bar, or you learn that they're never going to meet to hit the bar, and then you need to figure out what the path forward is with them. But the same is true of yourself. You rise to your own expectations. You take yourself seriously. You are building a real company. You have real ambition. You're really thinking big. Don't sell yourself short. Doesn't mean be completely delusional and unaware of what's going on. You should be very honest with yourself about like, this is not working. This is what I'm not doing well. This is what I'm doing well. Like you have to be very honest with yourself at any given point in time if you're actually going to drive towards that outcome. But if you keep that, if you really believe in building the big thing, you really stand by it, it will also be a forcing function for you to be honest, because you can't then just kind of lie to yourself, be like, I'm building this big thing and like everything's all working. So take yourself seriously. You're not building a project. You're building a company or a protocol, depending on where you are in the spectrum of infrastructure versus whatever, however you want to frame it. But you're building a real thing. Think big. Be clear about the scale of your ambitions. Say it out loud. Say it to yourself. Say it to your team. Say it to your co-founder, and like you will see how, if you take yourself seriously, things will usually go better than sometimes perhaps you even expect. So that's my number one piece of advice.
Awesome. That clip is going to get so much engagement. This is awesome, Kaledora. We had a great time. Looking forward to what's next for Ostium and what you guys do next. But yeah, thank you so much for your time today. Yeah.
Thank you guys. Thanks for having me. It's great chatting. Have a good day.
Bye.